Hey everybody, good to see you all today. Hope you've been having a great conference. I've been really excited to share this panel with you today. This is titled Blockchain and Beyond, and we're really going to get a chance to explore some of the most interesting things that people are doing with this new technology. And my goal of assembling this super panel that we have in front of us today is we have this incredible spectrum of different ways people are monetizing businesses and companies and applications on top of this new technology. It's really created this whole explosion of new business models. And so we have folks like Daniel representing Monetas, that they have no token involved. It is more of a traditional monetization model, all the way to folks that have issued native tokens, people that have created tokens on top of the Bitcoin blockchain. So we've really got all the bases covered. And I want to explore today why people came to these conclusions, why they embraced this particular way of monetizing their business or their application, because I think this spectrum is what we're going to see going forward, is people evaluating, okay, where does my application or where does my company fit in this spectrum? Is it simply a proprietary company or a licensing model and we don't need any token? Is it something where maybe we can issue something on blockchain, or is it something where we need our own technology and our own tokens? So that's what we're going to explore today. I really want to delve into the incentives that drove these different projects to make their different decisions. So without any further ado, I'm going to ask Daniel to kick us off. Tell us briefly about, in a few sentences, Monetas, why they've gone down the route they have, and sort of your beliefs. We've got a microphone we'll be passing around for the panelists to kind of talk about that end of the spectrum. We'll make our way down the spectrum. So, Daniel?
Okay, well, I just started with Monetas, so I don't know a whole lot about their history, and actually nobody told me that I was going to be representing them for this panel. I don't think I was actually technically employed by them at the time I was asked to be on the panel. So if I say anything that that Johan, the CEO, doesn't like, well, sorry, I didn't get a chance to call in with you on what I should say. But open transactions is it's based on an idea. It's sort of derived from Chaumian eCash, which is one of the earliest cypherpunk ideas, and whereas as Bitcoin is more related to later cypherpunk ideas like B-money and Bitcoin, and the idea of Chaumian eCash and open transactions is that you can create a digital banknote that can't be forged and cannot be manipulated by the user. Now, eCash could be manipulated by the central bank issuing it, but the idea of open transactions is that the issuer can't manipulate the amount, and there is a means of establishing a distributed consensus between users and issuer and some third party that is watching, in which everybody agrees that a contract has been fulfilled properly. It's basically a digital banknote, although you can use it for you can use it to represent any kind of good. You can have dollars or Bitcoins or chickens or whatever you would want to trade banknotes of.
Right. I think that's a great summary. So let's just run through real quick and give everybody a chance to.
I'll keep mine a little short. So we are. The company is Gem. I started it in 2013, January 2014. And we are a platform for developers to be able to build Bitcoin and blockchain apps. We provide a really secure wallet that is used by exchanges, payment processors, and you can also build consumer products with it. But speaking of funding, we went down the very, very traditional venture capital route. And the main reason for that, well, number one is that app tokens really hadn't taken off by the time we were doing that. But the other one is that, I think about it in terms of the total life cycle of a company. If you're going and doing an app token sale, that works really well at the sort of seed stage level, but I have questions about when you need to raise, you know, $10+ million or whatever to really scale a business. And so we just went down the very traditional route.
Yeah. I'm Reeve Collins, co-founder, CEO of Tether. We enable real-world currencies to work on the blockchain, so essentially dollars, euros, yen, to be transacted like Bitcoin. That's the quick summary, high level of what we do. We also went the traditional route of just raising money via the traditional channels, and that's because for our company, we're a service that enables other blockchain-based businesses to transact in both real-world currencies as well as Bitcoin. And so for us, it didn't make sense to issue an additional token because our tokens are simply backed by dollars, euros, yen, real-world currencies.
Greetings. I am Daniel Daybeck from representing the SAFE network from MadeSafe. And what I have is a startup called Infinity Algorithms. And the SAFE network allows you to create applications, and those applications get automatically compensated for based on their usage in the network. So we have an application that that creates, well, it's basically a client application. We could get into it more at 4 o'clock, but that application will be automatically paid for by the network, not by the people themselves. So very interesting.
Hi, I'm Peter Kirby from Factom. You might have heard of it. It's a data layer for the blockchain. And we run on a token called a factoid. And we chose that very specifically after beating our heads into the wall for a long time trying to figure out how to decentralize the system without it. And what we basically came to is that you absolutely can't have a decentralized system, a system not owned by anybody, if there's somebody in the middle writing checks. So we decided that we absolutely needed to have a token hardwired into the system so the software can pay for the hardware backbone. And that's why we made that decision. It also allowed us to do that thing that, that Paul talked about earlier about cryptocurrency isolation. We built it so the factoid stays in the sort of inner circle of Factom, and you can use entry credits, so a bank or an institution or any sort of other business that wants to use Factom can just buy essentially a software license, something that's non-transferable, and that makes it pure fintech. So it allowed us to decentralize the system and also isolate out the cryptocurrency.
My name is Anthony Diora. I'm a co-founder of the Ethereum project. Ethereum is a platform for building decentralized applications. And our goal is pretty much to create a Web 3.0, a web that's decentralized, censorship-proof, building up on, you know, the 1.0, which is basically static web pages, 2.0, which is JavaScript, and being able to do things like Gmail. And then the 3.0 will actually be a decentralized internet. Our choice to do a crowd-funded project was based on trying to get Ether, our token, into the hands of as many people in the community as possible. Last year, we did a 42-day sale, and we became the largest completed crowd-funded project of all time, raising $18 million and putting 9,000 purchases of Ether. So it put Ether in the hands of the community that's going to go out and now build these applications on top of our platform. So our biggest decision was to actually put Ether in the hands of the most people and the community and get them working with Ether.
Was it 18 million Canadian or? 31,000 Bitcoin. Hi, I'm Matt Rozak, founder of Tally Capital. I'm a venture capital investor. Been doing this for 18 years, and over the last 24 months now, I've been exclusively focused on blockchain technologies and Bitcoin. Investing in a lot of the bridges, roads, tunnels of the ecosystem, so wallets, payment processors, miners, exchanges, and also participated in 2 app token fundings. One was MadeSafe, and then also with Factom. I also want to put out a couple commercials here. I also just joined the board of BitGive Foundation. So I know Connie Galippi is here. Love for you guys to meet with her, listen to what BitGive is up to. And I'm also on the board of the Chamber of Digital Commerce. The Chamber is doing a special initiative today on the proposed legislation in California, which is pretty debilitating to Bitcoin. So I would pay attention to that. There's going to be a kind of a gathering around 4 o'clock to discuss that. So watch out for that.
So I want to start working back over the spectrum and examine the question of what are sort of the limitations that people are seeing in the systems. We've sort of heard briefly why people picked these systems. Ethereum ended up with 9,000 addresses participating. That created a large initial beta community, testers, people with an interest in the network. But where are you seeing the limitations? Where are you seeing the friction in these particular approaches? So just starting with Matt, what are you seeing in sort of the reaction of the traditional venture capital world? How are they adapting to this model? Where are the friction points for them?
I think in the traditional venture model, the limited partner charter documents typically have exclusions, which you cannot invest in, like, and they have oil and gas, real estate, commodities, or all these things that you can't play into, and some of that comes to the forefront when you talk about app tokens and digital currencies and whatnot. And what's happened over the last 24 months is that these charters, these discussions with LPs, it's been a friction point, because I think for going back trailing 12 months, the first 24 months, the first 12 months, it was every venture capitalist kind of woke up and smelled the Bitcoin. And they're like, okay, I got to pay attention to this, and I can't convince my investment committee, but I'm going to personally invest and dabble and educate and get into this. And then, last 12 months has been like, wake up and smell the blockchain, and then these app tokens, and then, okay, so we have to basically write letters and sit down with our LPs to say, we have to rewrite this provision here and get approval, because this is an important white space in tech investing and fintech, and get ourselves positioned to take advantage of these opportunities. So structurally, that's happened in the VC community. And then, the opposite to that, on the other end of the spectrum, you see this unbundling of institutional investing, where, yeah, you have 9,000 people showing up, banging on an Ethereum store to give them money or to give MaidSafe money. And this, kind of takes, the power of the VCs or the clout of the VCs and kind of democratizes it to say, anybody in this room that thinks, any of these guys have a bright idea, let's back them and let's get them off to the races. So it's a fascinating time in terms of the venture investment and just institutional investment into these types of technologies. It's and we're writing the book as we go. It's pretty amazing.
So I guess some friction points with the way that we decided to do things doing a crowd sale was, along with this community that we have now, we have to now be responsible to this massive community out there. I guess when you're raising funds through VCs, you could be responsible to the VCs, you're using their money. We're dealing with, thousands and thousands of people and have taken their money to get this project off the ground. So I guess being responsible to this community might be something that's a little bit more difficult than just being responsible to VCs.
Yeah, to build exactly on what Anthony was talking about, we learned a tremendous amount from watching what Ethereum did. They ran absolutely the gold standard of this, and they did an incredible job educating people and making sure everybody knew exactly what they were buying and exactly what they were doing. And what we learned from them also is this responsibility to the crowd thing. And this time, what Factom is doing that's slightly different is we built a series of milestones, and we have to hit those milestones in order for the funds to be released to the Factom Foundation. So we built like a sort of a technical approach on top of what Anthony was discussing. And what that means is that the Factom Foundation doesn't get a dime from the crowd sale until, the software sale, until we ship a beta. And that beta absolutely has to have a working token. So what we tried to do is build best practices as an industry and learn from the really great things that people did, and then also learn how we can sort of take that and build a new set of best practices. And I think that's how we can sort of self-govern as the regulatory environment evolves and as the people who make the laws of financial tools sort of learn exactly what to do with this and exactly what we should do to move forward.
Right. So in the SAFE network, because applications are automatically incentivized to, if they function and they're used, you get paid by the network itself. So basically, if you have something that is good and you put it into this network and people use it, then you will be compensated, and so you can make improvements on that system. So I'd mention that the biggest friction is that the safe network is so complex, let's say, that there are so many expansive landscapes that you can create with software architectures that, in fact, what to make, or rather how to approach the making of your idea, in fact, that's probably the biggest challenge. So you must consider that you won't be using servers, and you will need to keep the users in mind and focus on what the people actually need versus, you know, the cheapest way to go about doing things, because the cheapest way to go about doing things is already incorporated into the network itself. So essentially, you will no longer need to go and collect venture capital money. You will no longer really need to go, you know, above and beyond if you have a good idea. And if, you know, there's thousands of good ideas.
So you're saying it'll be an extremely competitive environment?
Right. So the environment will be so competitive that, in fact, right, we have this decentralized environment. So decentralized environments, you have collaboration. The Bitcoin was created, you know, started on the forum, right? MadeSafe also has a forum, and there's a lot of very interesting things happening on that forum. There's like 1,000 people there. You know, every month there's 120,000 views. So these are people who see common problems, and they can collectively address those common problems. So those developer coins go into a wallet, and then the custodian of that wallet can choose to allocate those coins to all the participants of that application. So you can have collective solutions to problems, and people will be paid based on their contribution and a vote of, you know, whoever's in control of that wallet.
And same question to you, Reeve. I mean, you guys were one of the first to put real-world fiat assets, and that's people have been talking about this for years. The idea of putting the dollar, the euro on the blockchain. You guys did it. What are the friction points that you're seeing, and how do you think you grow beyond those?
Well, specifically to address that, I guess our main friction point is initially building a brand around Tether, so people know who we are as individuals and people know who we are as a company and what our processes and procedures to build that level of trust, because this community is all about decentralization. But I argue that in order to get real scale for different types of business, it does require some level of centralization. You need to point the finger at somebody. Somebody needs to be held responsible, because we don't quite live in that perfect world yet where everything can be decentralized. We're getting there. And so for us, step one is to build that federation of banks, so you know your money's safe, to build that level of security, so you know your money's safe, to build that level of transparency, so you can audit that your money's safe, to build that level of trust, etc. And so that has been our friction point initially as a small startup, is to build that brand. So we've put a lot of novel approaches in place to enable the trust to be somewhat decentralized, utilizing Factom, for instance, to get the audits on the blockchain, and companies like TSL Notary, and doing some really interesting things with them so people can piggyback and see what's in our bank account, etc., allowing the community to audit both the fiat bank balances, and then, as you all know, the tokens can be audited on the blockchain already. So once we iron out all of those kinks, which we're about to release all of that work here very shortly, people can realize that the amount of trust and the amount of centralization is as minimal as possible. So, yeah.
I guess I'll answer the original question, which is, like, I think that there can be a separation between using a sort of, you know, decentralized protocol and building your processes on top of something that is totally decentralized, and building a company, which is a totally different thing, which does not have to be a decentralized distributed system. And in fact, there's a lot of advantages to not being a decentralized company. You know, I think we underestimate how much luck and timing was involved in the success of Bitcoin. You know, there was like turmoil in the financial markets. There were a lot of things that were going on that allowed Bitcoin to be really successful, in spite of the fact that it was a decentralized and distributed system, in terms of getting very large market share and knowledge. But a centralized institution can actually do a better job of things like marketing, for instance. So if you think about one of the most powerful brands in the world, it's Apple. And Apple's probably one of the most centralized institutions that's out there. So I think that's one of the things that I see kind of across the board in terms of, in this industry, people have a hard time marketing their services. And when you if you want to leave marketing to a giant consensus, that can be very difficult. On the other hand, you can build a community much better. And so there's pros and cons to both sides.
Could you repeat the question, please?
Sure. So we've talked about some of the reasons that people have picked these particular models, and it's all roses and gems and things are great, and we're exploring sort of what are the friction points here. And so Monetas, for example, has created this incredible open source software built on top of open transactions, and they're offering these new ways of doing eCash, like you mentioned, and that's opening a lot of options for institutions that want a proprietary solution, maybe something maybe built on top of open source. But I'm just interested, what are the friction points you're running into? How do you get beyond those? Feel free to broaden the subject. I know you're new at Monetas, and feel free to speak from your personal perspective. What are the limitations of the traditional model and how you grow beyond that?
Oh, well, okay. If by friction point you mean limitation of traditional model, I usually think of friction as the normal force times a constant. But I mean, right now we have all of these Bitcoin exchanges that can just disappear with all the money. And, people send all of their Bitcoins to these markets on the Silk Road, and then they disappear and lose all their money. All of these Bitcoin companies get hacked, and the hacker takes all the money. So one of the goals of building the Monetas system is a means that a central institution can hold Bitcoins without being capable of manipulating people's balances or running off with all the money. So we're working on this idea called voting pools, which will hopefully help prevent that. And in this way, lots of different institutions will be able to hold Bitcoins in a pool, and will only be able to move Bitcoins out if a certain percentage can prove to another that the withdrawal is valid.
No, this is really interesting technology, and I'm glad that you guys are out there building on top of open transactions, because it's sort of the realization of what people have been talking about for a long time, and creating that impossibility of fraud inside these systems, I think, is really important. So let me bring it back around. What are the advantages of the systems? What are the friction points and disadvantages of these systems? Talk to me about how people build on top of your system. So now we know a little bit about the tokens that operate within your system. How do people interact with an API? Do they get a license? How does that ecosystem grow on top?
Oh, I don't know the answer to that one. We're still working on that one, I think.
Fair enough. And I think in your case, I've talked to Johan a number of times, and I think he has a great vision for how you license this to institutions that want to build this kind of auditability and these different features into it. So, I think what you guys are looking at is more of a traditional, let's go after enterprise, let's get them to use this technology and get these new capabilities in their hands. So, James, you want to?
Yeah, so when I was talking about centralization, I really mean about the company side. Actually, we were really a big believer in decentralization of risk. So the GEM platform is based on 2 of 3 multi-signature wallets, and GEM only holds one of those keys. So GEM is never in possession of enough keys to be able to spend our customers' money without them. So what we really do is we provide security for exchanges, merchant service providers, and allow them all the same features that a bank provides, but they get to own and control their own assets. So we really believe in that. And so essentially, our model is that we provide the core layer of services to companies that they can build on top of as an API. We give them all the client libraries in multiple languages. We make it really, really easy, so you don't have to think about keys. You don't have to deal with key management. And then essentially, we have a free product that we give to developers, and then we have an enterprise product that companies can pay for that gives them a lot more bells and whistles.
And is your guys' API live today?
Yeah, we've been in private beta. We're going to be making some announcements very, very, very soon. So if you do want early access, you can certainly talk to me.
Great. Yeah, that's what's really exciting about the times that we're in today, is that the blockchain is still being built. The foundation is still being laid. And a lot of our companies here, we are foundational layers of the blockchain. And what we're talking about is all the apps and the native apps that will be built on top of it in the future. And so we also have a very exciting future ahead of us because we don't even know what those apps are going to be yet. But I like to say that Tether is one of the foundational layers of the blockchain, because as new companies are being built and new entrepreneurs are utilizing this amazing technology of the blockchain and they're building new businesses, they can plug into these layers. Our layer is real-world currency. So now they can offer their goods and services not only just in Bitcoin, but also in currencies that their customers are familiar with using. And so that's how we see ourselves as one of these layers, and the way people are going to build on top of it is whatever they can dream up of, whatever native app to the blockchain or whatever kind of business that they're going to build on top of this technology, now they can simply use currency as well.
Right, so the Safe Network itself, it allows you to store any type of data you could ever want to store. So if you create a client that parses out specific files of data, you can do phenomenal things. So, right, so this is kind of like the gate. If you put like a text file, you can interpret the text file, you could read a book. If you put a movie, you interpret the movie file, you can watch the movie. So that is all accomplished with a very simple API, you know, a put and a get or a delete, right? And there's also an update, of course. And so then, like usual, it's up to your imagination on how you want to use the data that is sent through. So for example, my company, Infinity Algorithms, creates a client called SafeX Client. And using a specification called SafeX Protocol, we use the Safe Network itself to send a message through this autonomous system that can take this data, store it, and then when someone scans for the header, can get that data, read it, and parse it out and understand some kind of financial information. So what does that let us do? We can put anything we want into a financial transaction and then have the client on the other end read that financial transaction and understand it. So this is just one way to utilize this, like, you know, I call it like, it's like artificial intelligent, like super brain for internet computing. Yeah.
That's great.
Yeah, so that's probably the hurdle, like what to do with that.
Yeah, Daniel brings up this really awesome point that these blockchain technologies are capable of absolutely incredible things, but in order for them to be user-friendly, in order for a banker, a technology person in a bank to write software, in order for an insurance company to write software, the APIs have to be very, very simple. You know, Paul makes the joke that Factom does practically nothing, but it allows you to do practically anything, right? The simpler the technology and the simpler the API interface and the simpler it is to get projects built quickly, the more projects that get to be built. And we always say that Factom thrives when 1,000 businesses get built on top of it. And right away, you know, big institutions, banks, governments, insurance companies, medical records reached out to Factom because being able to make their data immutable, you know, write once, never unwrite, is a really, really big deal. So that's the simple thing is businesses get built on top of Factom. Now you pay to publish. That's basically the business model. There's a small cost every time you want to write something, and you can read it forever. So it's pretty simple. The blockchain technology is amazing. It's complicated when you start digging into the guts of it. But as a general rule, you don't. That's not how you build software. You build software with applications that you understand and small API calls. And that's really how you move forward.
So how do we get people developing decentralized applications on Ethereum? Simplicity is probably the key word. Our goal is to build out Ethereum in many different languages. We've got C++, we've got Java, we've got Go, a few others as well. And the stage we're at is building the infrastructure, which is what Reeve was talking about. Our first release called Frontier will be the very basic infrastructure of Ethereum with mining and people being able to make contracts. Completely, you know, put towards developers, be command line based. The second one, called Frontier, will actually be more advanced. It will actually be using real Ether. So we are using a small percentage of Ether sorry. With Frontier, we're using a very small percentage of Ether. It's 1/10 actually will be out there and being able to use. So it's taking it off the test net and using very small amounts of Ether, and the rewards will be a lot smaller. On the Homestead version, it'll be real Ether, and people will be able to use that, and it'll start leading up towards Metropolis, which is more of the user experience and actually the end user. So you'll have what we have is called the Mist browser, the Mist dashboard, where people will be able to install applications, and we'll be building up all of the applications, and people will be able to publish them on there, and that'll be the full dashboard. It's very similar to a Play Store or very similar to an App Store. And it's all about getting applications built right now by developers, and in the future, the end users being able to use those applications.
I think you're hearing a lot of this community engagement, this developer engagement across the panel here, and that's a core competency for any of these app tokens, because there's this, not even the last mile. There's a distance, this connective tissue between their, foundational blockchain infrastructure and then a Fortune 1000 customer to be able to absorb that, utilize that, leverage that in any particular way, whether you're a bank or pick your household name company that wants to embrace blockchain technologies, or a government that wants to embrace blockchain technologies. You need a developer community to build those apps, to market and get those apps out to these customers. And then there's this competition for these developers. There's only so many developers out there. And so, again, this core competency of being able to have an incentive structure, have a community, have a management team, have a kind of a compass that points in the right direction. This is going to be a successful infrastructure app is very critical. And I think, we have a representative group here of these infrastructure technologies, but this is multiplying on a daily basis. And so the attention for all these great developers to really climb up the mountain here is going to be, again, back to this core competency concept.
So tell me where we're going. The title in our panel today is Blockchain and Beyond. So tell me about the beyond. Tell me where we're going to be in a year. Tell me where we're going to be in 5 years in your particular part of the ecosystem or the method you're using. Project this forward. What are we going to be talking about next year at the 3rd annual Texas Bitcoin Conference? What are we going to be talking about at the 8th Texas Bitcoin Conference? Walk me through that. Where does this lead?
Well, one project I'm really excited about is Blockstream and their sidechain project that they're kind of in the middle of. And I think that as a concept, it's still a concept, but once that launches, the promise of sidechains to help extensify and create more utility out of the blockchain, I think that's something that will be a game changer and might be something that a lot of people on this panel might adjust their compass on their strategy to say, how do I engage into a sidechain? And maybe that is a railroad adjacent to a railroad where they're able to speak and peg into each other and really create this ability to see the promise of the blockchain versus what we see today, which is slow transactions and all the kind of stuck in molasses that we're kind of seeing, that we can't see the transactions that we're all predicting happening on the blockchain as it exists today.
So to summarize, things will become more interoperable.
Yes.
Okay.
Yeah.
The end game for Ethereum is the new internet, an internet that is decentralized. I envision a brand new space where people are creating decentralized applications in a peer-to-peer fashion, removing a lot of the things, the third parties, removing a lot of the costs, removing censorship, and basically changing the way that we see the internet these days.
Well, in 2015, we will see major institutions make announcements about what their blockchain strategy looks like. We've been talking to lots of organizations, and we know that every single one has a working group looking at blockchain strategy, looking at the Bitcoin, looking at what's going on in this space, and actively asking themselves how can they use that to solve a pain in their business process. So you will see one major bank, one major government, one major insurance company, all basically say, we're going to be the leaders here. And as they all say, we want to be fast followers. Once one bank says, yes, this is our blockchain strategy, every single other one will happen. Once one big accounting firm says, this is how we're going to do audits on the blockchain, everyone's going to happen. So you're going to see this huge rush of people into this space. And as Matt was saying earlier, it's a developer problem, right? At some point, we don't have enough skilled people who understand this technology. So you're also going to see a massive upswing in, you know, the price of developers, I hate to say, but also the excitement in the developer community. They recognize that there is a six-figure job, you know, in the high sixes if they really understand this stuff. So, you know, big institutions and developer talent will follow very quickly. I think that they're very linked because it's a credibility problem. And then I think, like, frankly, the 8th Texas Bitcoin Conference, first of all, it's probably going to be called the Blockchain Conference because at some point, like, blockchain technology is really what we're talking about here. But I think the topic is going to be like, the blockchain is boring, it's baked into everything already. And I think that once you understand what you can do with this technology, you know, David said this beautifully once upon a time, 1 billion people will be using the blockchain and most of them won't know it. So those are my predictions for the future.
Very cool.
Yeah, so Safe Network actually doesn't use blockchains, fundamentally. Yeah, actually, the interesting thing is that there's a deduplication feature in the Safe Network, and so you have the Bitcoin blockchain, and it's whatever amount of gigabytes size, and it grows as it grows, and so you can use a deduplication feature of Safe Network, put the blockchain into the Safe Network, you know, the current approved consensus on the blockchain, and put that file to the Safe Network. And then if anybody tried to put the next one, they won't have to pay SafeCoins to put that blockchain into the Safe Network because someone already did. So deduplication will cut it out. But the thing that we accomplished there is that we have a common file that we can all now target, and now every client can just access Safe Network with a Bitcoin wallet and read the entire blockchain from a one decentralized autonomous network. So that's pretty neat. And Factom even will have some blockchains going into the Safe Network to prove some physical goods and stuff like this, and
Very
digital
cool.
goods. So we are already beyond the blockchain, and we are embracing the blockchain, as well as moving forward beyond the blockchain.
Very cool. Well, we got 3 more minutes, 3 more panelists. So take us home. Where are we going? What's the future?
All right. 2 things, really. Interoperability. You guys touched on that, which I completely agree with, because we say the blockchain up here, and we're typically referring to the Bitcoin blockchain, but there are lots of other blockchains out there. But soon, they will be very interoperable, and so that won't really be an issue. The second thing is, I don't think we'll be talking about the blockchain anymore. We won't be talking about the technical details and how everything works. It will be focused on what we can do with it, because in a few years, people will realize the technology is there and they'll trust it, and we'll stop really focusing on that and more on the utility of what we can get from it. So,
all right, my 2 predictions, one is financial and one is non. So in the financial world, I think it goes well beyond buying and selling a cup of coffee. It goes to interbank settlement at the highest level of the financial system. So trillions of dollars are moved around the world every day, and there's a risk that's associated with those transactions. They can be clawed back from 3 to 10 days, depending on the SWIFT network versus SEPA or whatever. These interbank transactions are massive, and if you could just eliminate a fraction of risk on those transactions, you could save billions of dollars for the banks, and so the banks are looking at this as a solution. So that will happen, in my opinion, and they're already looking at it. The second is, you know, if you really think about what Bitcoin is, it's a language that allows any 2 entities to be able to exchange value with each other, and I say entity and not people, because it also works very well for machines. So in a lot of ways, this is a language for machines to exchange value with other machines. And so I can see a world where, you know, self-driving cars are negotiating with freeway overpasses overhead, paying for tolls. There will be an autonomous self-driving car, Uber. That's what I think.
That's great. And Daniel?
So currencies don't give dividends, and they don't have interest. So The only explanation for the value of a currency is the fact that everybody else has it. There's general demand for it. If you get stranded on an island and everybody has worthless beads and they're trading with that, you want to get some because everybody else had some. So since the altcoin manias got started in Bitcoin, the altcoins have sort of been going up and down with Bitcoin. But when you think about it, this doesn't actually make any sense. I mean, people say like they're like, Bitcoin penny stocks or something. But this doesn't make any sense because the value of a currency is the network itself. It's the network of people using it. So my prediction is that eventually we'll see Bitcoin decouple from the altcoins, and all of them will start to go down, and Bitcoin will start to go up. But it could also happen that Bitcoin will just go down and everything will go down to nothing and everybody will be laughing at us. But I certainly don't think that it makes any sense to create alternate cryptocurrencies. And I really hope I never hear the phrase blockchain tech again. There's only one blockchain that matters, and that's Bitcoin.
There you go. Well, thank you for this panel. We get a round of applause real quick for these folks. I really believe this is some of the best technology in the whole ecosystem, so definitely corner these people afterwards. Thank you, guys.